Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to be talking about the S&P 500, and we're going to be providing a general outlook. We will look at the recent performance of the S&P 500. We will take a look at seasonality. We will compare the current chart to prior bear markets just to see how it stacks up. And we'll also look at some of the yield curve inversion stuff, okay? Or ROI after yield curve inversion. So let's go ahead and jump in. So right now the S&P is coming in at around 4,200, 4,224. And back in the last video that we did on the S&P 500, it was about 2 weeks ago. And we said that in the short term, after getting this seasonal correction by the S&P 500 in August and September, we would expect a short-term bounce at the very least, right? And in fact, October 3rd was the date we discussed, because October 3rd, this is where the low was, but also October 3rd is actually precisely where the S&P 500 got a bounce back in 2019, right? It got a bounce in 2019. You can see that it bounced, it then came back down, and then continued to go up. But there are some nuances, some differences between that move and the one we are experiencing right now in terms of where we are with respect to some key moving averages that a lot of people might follow. For instance, back in 2019, this bounce, if you look at the 200-day moving average, we actually never got back below the 200-day moving average, right, in that seasonal correction by the S&P 500. And if you're not familiar with what seasonal correction I'm talking about, if you go to the year-to-date ROI of the S&P, it looks like this, right? So this is a 2023 year-to-date ROI. And we suggested back in July, we said that what will likely happen is we will get a 5 to 10% correction in the S&P 500 in August and September, and that correction will knock crypto into a downtrend, right? It'll knock Bitcoin below the bull market support band. It'll knock crypto into a downtrend. Now, of course, Bitcoin has rallied back up at the current time, but the altcoin market is really struggling, and there's no guarantees that Bitcoin will continue to hold up for the rest of the year. There's still a chance, I think, that it could also roll over. But the interesting thing, right, is that if you compare this move, this pullback by the S&P 500, and you compare it to the average of all prior pre-election years, this is what it looks like, okay? And we said, all right, look, if you look specifically at 2019, you can see there was a correction in that August to September timeframe. Same thing with 2015, a pretty big drop in that same time frame. Same thing with 2011, right? And so on and so forth, right? See, we went through these pre-election years, and we saw what the S&P 500 typically did in the August to September timeframe. And when you average out all prior pre-election years, going back to the late 1920s, you get something that looks like this. So the S&P 500, while it was up more than it normally is by July of pre-election years by a significant amount, you can see that the S&P was up about 12%. Normally, it's only up about if you look at the average, it was up 20%. The average is about 12%, right? So it was actually up 20%. But the pullback was more severe than what we typically get on average, and the reason I think is because we were more extended than we typically are on average. So the correction that we saw by the S&P 500 in August and September actually got us back down to where we normally are at this point in pre-election years, right? Nothing more, nothing less. Now, there were a lot of people that suggested that the bond market would do well if the S&P were to drop, right? They said, well, it's going to be a hedge. But, I put out a tweet and I talked about it back then that I thought that we were about to enter into a period, a several week window where both stocks and bonds would drop, right? We said both stocks and bonds would likely drop. And if you go look at the S&P 500, what you'll notice is that it dropped from these July highs, dropped about 8%, right? We suggested about 5 to 10% is pretty reasonable in the August to September timeframe of pre-election years. So it dropped about 8%. And the bond market, right, if you go look at say, TLT, which is currently at 83, also dropped a lot, right? So if you go look at where this was in July, and I'm not gonna, I don't make many videos on this because I know people don't really care as much, but the TLT dropped 18%, right? Actually, a little bit more if I actually go down to the very bottom there, right? 19%. So in fact, our assessment was that the stock market would drop and that the bonds would drop too, right? So there's really not a great place to hide in that sense, right? So the stock market and the bond market would both drop at the same time. A lot of people will sort of balance out their portfolio to be stocks and bonds with the idea that the bond market will offer as a hedge in case, in case something bad were to happen with the stock market. But the issue is that, and we talked about this back then, was that the markets were not at that point yet really pricing in higher for longer, right? The 30-year at the time, right? The 30-year at the time back in July was only at like 4%. Now it's at 5%. That's a really big move. The 10-year, which is now at 4.9%, back in July was at 3.8. So because the long end of the yield curve went up into, and with regards to the yield curve, a bear steepener, the long end went up rather than the short end going down. The long end of the yield curve went up, therefore TLT went down. So we went into a period where both stocks and bonds went down. But some people went into this phase, right, suggesting that bonds would offer a hedge against the stock market if the stock market were to fall. But as we said back then, I did not think that the market was pricing in higher for longer. And furthermore, while the correction might seem severe to some, this is exactly where we normally are at this point in pre-election years, right? This is where we normally are, right? So the reason, arguably, that the bond market hasn't necessarily taken a hit is because the market still was not pricing in higher for longer, but also this correction by the S&P is not really that significant so far, right? It's not that significant so far. And so while yields have gone up a lot, and it's put a lot of pressure on risk assets, right, as the 10-year goes up, right? If you look at the 30-year, and if you were to overlay the S&P 500 onto this chart, what you'll see, right, is if the 30-year is screaming to the upside, then the S&P is normally going to the downside. Normally, right? Not always, but normally. There's a lot of cases to be made where you'll see something very similar, right? So like if the 30-year is going up, the S&P is going down. If the 30-year is going down, the S&P is going up. So you can see over here, the S&P was going up while the 30-year was mostly just in a range. But once the 30-year broke out here, right, once it really started to break out, the S&P started to sell off. Okay, so as the long end of the yield curve goes up, the S&P sells off. Now, why is that? Why is that? Well, I think you could argue that the higher the long end goes, the more likely that CEOs and people that run these, corporations that hire tons and tons of people, they recognize that the cost of capital is getting more expensive, right? It's cash isn't as cheap as it once was with interest rates so high. Therefore, they partake in cost-cutting measures because they're now recognizing that higher for longer is a thing that isn't just sort of like something that the Fed's saying, but they actually seem to be meaning it. So when the market recognizes that, it can then lead to companies cutting costs. Now, the issue, though, is when the company cuts costs, people get laid off. And if people get laid off, that can eventually lead to a recession, right? I mean, again, like at this point, the labor market has remained relatively tight, and it could still take some time to see that weakness in the labor market. But again, when the long end goes up as quickly as it has led to a risk-off environment in the stock market. But here's the catch, right? Here's the catch. At some point, we will likely see the long end of the yield curve go down at some point. But just because it goes down does not necessarily mean that the stock market will go up. If the long end of the yield curve is going down and the economy is still seemingly okay, then the stock market could rally. But there's also a chance that the long end of the yield curve could go down for the wrong reasons, right? If you imagine, if the market starts to sniff out that the Fed has gone too far, and we'll have to go back to lower rates just to help try to stimulate the economy, right? Because again, all these interest rate hikes, they have long and variable lags. And it seems like we're reaching the point, about a year out from all these 75 basis point rate hikes, where a lot of people are saying, all right, interest rates have no effect, right? But we're now just entering into the point where you could argue the economy is finally starting to feel the effects of all of these interest rate hikes, at least the majority of them, right? And so with that in mind, we have to ask ourselves, well, what happens if the long and variable lags of all these rate hikes hit the economy sometime over the next 6 months? And if that happens, and the market is sniffing out that the Fed has gone too far, and if rates start dropping because the market is, say, expecting the economy to be relatively weak for a while, then the long end of the yield curve could go down, but for the wrong reasons. Okay, and if the long end of the yield curve goes down for the wrong reasons, then that means the S&P does not necessarily have to go up. If we were to look at examples, right, I think the best thing we could do is look at examples rather than to just say these claims without really providing any evidence. And again, I mean, we structurally speaking, right, like this has just been trending down for a long time, right? But you can see here, right, here's a great example in 2008 where the 30-year, right, the 30-year was going down, but the S&P was also going down. Here's another example, right, where you can see the 30-year was going down, but the S&P was also going down. So just because the 30-year going down has been meaning for a while that the stock market would then go up, today was actually an example where they both went down together, right? So like the 30-year dropped 0.65%, but the S&P also dropped, right? So a lot of people were like, well, what's going on? I mean, rates are down. Shouldn't the stock market be up? Now, it is possible that it's just sort of a delayed effect, right? It's possible that the S&P will rally, later in the month or in November or something. But there's also a chance, as the context of history shows us, that if the Fed has gone too far and the long end of the yield curve starts to go down, it means the stock market can go down with it if the Fed has done too much damage. Because again, even if the Fed were to realize they've done too much damage, and even if they decide to cut, right, which it doesn't really seem like is the most likely outcome right at this moment, but even if they were to decide to cut, the first cut is not normally the one that saves the stock market. If we were to recognize all of a sudden that, oh crap, all these rate hikes are now going to affect the economy, if the Fed knocks off, say, 50 basis points off the terminal or off the Fed funds rate, that's not going to immediately impact the economy, right? It's not like all the CEOs are going to say, oh, well, now let's go hire a lot of people because they've knocked 50 basis points off. No, it takes time for that stuff to filter through, for the economy to really adjust to that interest rate. And that is one of the reasons why the stock market often is dropping when the Fed is cutting rates, right? A lot of people think that the Fed cutting rates is a good thing. A lot of times when the Fed's cutting rates, it means they've gone too far, right? It means they've gone too far. So the question that should be on everyone's mind, right? And again, like if you're not thinking about this, I think this is a lot more important than how your altcoins are doing this weekend. Okay, how much further can the long end of the yield curve go up before risk assets say enough is enough and they drop, right? How much longer? It's possible we've already reached that point. It's also possible that the long end of the yield curve could go to where the short end of the yield curve is, right? It's possible that the long end could go to 5.5%. But I will say that as the long end of the yield curve continues to go up, right? As it continues to go up and TLT continues to go down, the bond market would become increasingly attractive with respect to equities, right? With respect to equities. Because remember, if the 30-year goes down and the 10-year goes down, right? If the long end of the yield curve is going down, right? At the 20-year, right? But if the long end of the yield curve is going down and the stock market is going down, then the bond market actually offers up a hedge, right? But for the last couple of years, it hasn't really been a great hedge because as the stock market has gone down, so too has the bond market. So that's, I think, the question that a lot of investors should be asking themselves right now is how much is enough? How much higher can the long end go before risk assets can't handle it anymore? And just look at what's been going on here, right, with the 10-year, right? I mean, look at what's happened here. So you can see the 10-year, once it really broke out here, I mean, the S&P has been falling as the 10-year has been going up. And I mean, again, the issue is like how much more can the S&P 500 take if the long end of the yield curve were to go up? Now, there could be some speculation that there could be an intermediate period where rates where the long end of the yield curve could slowly come back down, and then the stock market could get a bounce or something after a more definitive Fed pause. But the further we go into the cycle, right? Because we're getting pretty late, I think. The further we go, the time period between the last rate hike and the first rate cut is obviously going to continue to narrow. So this is, I think, one of the most important things that investors should be looking at right now, right? Much more important than the altcoin market that I know a lot of people are more interested in. Much more important than that. I mean, look, guys, it's the same thing in the crypto market, right? I mean, yeah, Bitcoin is up. We know that. But why is Bitcoin up? It's because the rest of the market has been bleeding, right? Altcoins are bleeding, just like the stock market is, right? They're bleeding. And Bitcoin is reaping the rewards of that because a lot of them are bleeding back into Bitcoin. Again, just as sort of like a reminder, look at the Ethereum Bitcoin valuation, right? Look at this valuation, and you can see that it's absolutely capitulating right now. You see the Ether Bitcoin? This is it's capitulating. So it's happening across all markets, right? It's happening across all, or at least a lot of markets. Bitcoin is up, but again, I think it's mostly due to liquidity from the altcoin market going into Bitcoin. And that's the question, is how much more can the stock market take? So when you look at year-to-date return on investment of the S&P 500, at this point, you might say, well, why hasn't the bond market shown strength yet? Well, why should it? Right? It's the S&P is where it normally is in pre-election years, right? I mean, this is legitimately, look at this. At this point in prior pre-election years, the S&P 500 on average, going back to all the way to the late 1920s, on average is up 11%, which is exactly where it is right now. So why should the bond market care at this point, right? I mean, just because it had, an 8% drop doesn't necessarily mean it's the end of the world, right? It doesn't necessarily have to mean recession now. It could still mean recession in 3 months or recession in 6 months, right? But where it could become a potential issue is if it doesn't stop here, right? So when you go look at the S&P 500, it did get this bounce from October 3rd, but what happened? Where did it get rejected? I'm sure you know, right? The bull market support band, right? That's where it got rejected. And that could become an issue, right? If this turns into resistance and the stock market continues to put in lower highs and lower lows, then the bond market could start to care, right? So like imagine for a minute that the S&P, instead of just stopping here, imagine it drops another 5% or something. Then we're outside of a seasonal correction, right? Because you could argue that a 5 to 10% correction in August and September is a seasonal correction. It would be expected. It was why the bond market had room to continue to sell off, even though people were upset that the S&P was going down and the bond market was going down. But where does the bond market actually become a hedge? And when you look at this chart, I think we could imagine that if the S&P were to continue to drop, let's say where it's only up 5% on the year or 7% on the year, then it's going to maybe start to leave investors scratching their heads a little bit as to think like, well, is this just a seasonal correction or is it something more? One of the things you'll note is that there's often seasonality in markets, right? If you were to look at 2021 and look kind of see how the stock market behaves in 2021, pretty good, right? And then look at 2017, pretty good year. 2013, these are post-election years, right? Post-election years, right? They're pretty good on average. Now go back to 2009. It ended the year where it normally does, but not before a massive sell-off in a recession. Now, look at 2001. It was not where it normally is. And why is that? Seasonality is an important thing, right? It is. I mean, the markets are fairly seasonal. It was how we were able to sort of speculate on a correction in August and September, but they're not everything. And if a recession comes, then it changes the outlook, right? Because if a recession comes, just like 2001, just like 2009, you kind of throw seasonality out the window and say, well, the labor market, takes, I mean, it takes priority. If the labor market is weak, then the stock market is going to focus on that. Remember, a lot of things don't matter, like the labor market. A lot of times, the market doesn't really seem to care that much about it as long as it's not moving too much. But once it matters, it's the only thing that matters. And so far, hasn't mattered, right? But what happens if we start printing 4% unemployment or 5% unemployment in the next 6 months? That's where it could become a problem. Okay, again, at this point, the labor market has still remained relatively tight, and it hasn't been an issue. Okay, so when I look at the stock market, right, what do I notice at this point? I notice a rejection off the 20-week moving average. I noticed that it just put in a daily close below the 200-day moving average, which was not something that it did in 2019 at that point in the cycle, right? I mean, it of course does go below the 200-day SMA sometimes. You can see that it did in May, and it still recovered. So if the S&P is able to bounce from here into the end of the month, then it's kicking the can down the road, kicking the can down the road, saying the economy is still strong. So what about the inverted yield curve? It still has time to work itself out. But if it doesn't do that, and it keeps spending time below the 200-day SMA, then that's where, again, it could become a problem, right? Look at 2018, right? Look at 2018. Look at 2020, of course, was the pandemic. But there's plenty of examples where you can see sometimes we go below the 200-day, and then we end up spending a lot of time below the 200-day. This, by the way, was not a recession, but it was a recession scare where a lot of people thought it was going to be a recession. Okay? That was 2016, right? 2020 was a recession. What will 2024 be? Probably either a recession or a recession scare is my guess, where it comes really close to being a recession, but it's not quite one, or it actually is a recession. In either case, you can make a case that the S&P could still show relative weakness. The other thing, too, and I said this before, is that I think there's a good chance that this is the yearly high, right? There's a good chance that this is, in fact, the yearly high for the S&P 500 in July. And the reason I say that is if you look at 2023 and you compare the S&P to all prior pre-election years, normally we end the year up about 14%, right? And we already went up 20% in July. So I think it's relatively unlikely that we make it back up to 20% off the yearly open in the next 2 months. It's not impossible for it to happen, but I think it's more likely that we either chop like this. Maybe it goes through some periods where it goes slightly up and slightly down, but I think that's either more likely, or it starts to show weakness as the labor market starts to unravel. But again, I think for now, the bond market hasn't cared because this is where the S&P normally is at this point in pre-election years. So that's why we have to focus on this. Now, you might say, well, what's going on, with the S&P 500? I know a lot of people look at this and say that that the bear market of 2022 is over and that we're never going to go back down to those levels. But is that necessarily true? And I think that's the question that we have to be asking ourselves. And one thing we can look at is the ROI of the S&P 500 during prior bear markets going back to the Great Depression. And what you'll notice is that there are periods where the S&P 500 gets a significant rally, and it still doesn't mean that we can't take out the prior low, right? Go take a look at the 1970s, by the way, which was a period of high inflation. In that period, we actually put in higher highs and still took out the prior low, right? So if you fall in the camp of, oh, well, if the S&P puts in a higher high, that means that we can't go put in a new low. Well, you should take a look at what happened in the 1970s, where we basically spent a decade putting in higher highs, but also putting in lower lows. Okay. That was brutal. Absolutely brutal. But that's what happened. A decade of higher highs and lower lows. So just because you put in a higher high doesn't necessarily mean anything, right? You could still roll over into a recession and put in a lower low, which is exactly what happened in the 1970s, right? This started here. This was 1966. This bottom over here was 1974. I mean, legitimately, you're looking at 1978. We were at the same valuation we were at in 1965. 13 years earlier. 13 years. I don't want to see this happen. Powell has said he doesn't want to see this happen, right? Higher for longer, that I think is now being priced in, could actually make companies cut costs. And that could actually lead to lower inflation, which might help us avoid something like this. I mean, Powell said in his own words, he wants to get back to your period of economic expansion, sustained economic expansion, but you can't do that if inflation is running at like 3 to 4%, right? It's not, people, it's hard to live like that. It's hard to afford things if everything's going up that quickly. So the next few weeks, I think, are important for the S&P. Can it stay above the 200? Can it get back above the 200-day SMA? Can it hold on to these levels, or does it show weakness? Now, when you look at the ROI, the S&P 500 from the peak, and you compare it to other cycles, you can see some similarities, right? I'm just sort of going through some of them. This is the one from 1946 to 1949. This was coming out of World War II. Also a period of high inflation because we had a lot of money printing to support the war. We had a lot of money printing this time, because of the pandemic. I mean, it's, not the same thing, of course, but there was still a lot of money printing. And I mean, you can see in this case, the S&P just didn't go anywhere for like 3 years. And then once we finally got through 1946, right, once we were on day 1111, which is how long this took. We're currently, by the way, on day, 655 or so. But once we reach this point, look what happened after that. Massive bull market into another period of economic expansion. But not before we had 3 years of just sort of relatively boring price action in the S&P. Pretty impressive rally, by the way, right? This was an impressive rally too. Still faded to put in a new low. There's some other comparisons we can make as well. A lot of these analogs don't really match up that well. But I mean, you can sort of just look at a few of them and see kind of where they are, where they ended. Here's 1968 to 1970. Here's 1973 to 1974. This was arguably a hard landing. Here's 1980 to 1982. This is the dot-com crash. Here's the financial crisis, right? Now, another thing that's interesting is to look at, there's one outlier event. So let's talk about the outlier event first, and then let's look at yield curve inversion, ROI after yield curve inversion. So we talked about seasonal behavior, right? And seasonally, pre-election years are pretty good for the S&P, right? They tend to go up. We get a correction, but on average, they tend to grind higher. There are some exceptions though, right? One exception is 1987. Okay, 1987 saw something look like this, where the S&P 500 went up, 40%, and then crashed all the way down here. Now, you might say, well, Ben, looks nothing like that this time, right? The S&P didn't go up 40%. Why should we be why should we be worried about something like that? Well, maybe the S&P didn't go up that much, but the NASDAQ did, okay? And if you look at the NASDAQ year-to-date ROI in 2023, you can see it went up about 40%. And if you overlay 1987, that's what it looks like, okay? So am I saying this has to happen? Absolutely not. Absolutely not. We know that the S&P 500 at this point is at where it normally is in pre-election years. We know that. We saw that earlier. And it's why the bond market has continued to go down, because it's normally what it does. It's normally what the S&P does at this time. So I think investors overall aren't as concerned with where the economy is. But what happens if later this month or in November this just starts to sell off quickly. Then at some point, the bond market does really become a great hedge against the S&P 500 dropping, because then at that point, the market's like, oh crap, like the Fed went too far, and the economy just simply cannot sustain. They just simply cannot sustain it. So if you were to see something like this, the Fed would pivot a lot quicker than a lot of people think they would, right? They would. I mean, if you look at the S&P 500, by the way, in 1987, and it's sort of this move right here, if we were to overlay interest rates, right? What I mean, the Fed was raising rates, right? I mean, they went from, it started off at 6%, and they were raising rates, and then they got to about 7.25. The minute the S&P did this, you better believe they started cutting rates, right? They cut them back to 6.5, right? They took off about 75 basis points, almost. I mean, right when it dropped, right? So I mean, and by the way, this was a huge drop. I mean, from from the top, this was a 36% drop. So, I mean, if you think about that, like what would that look like today? Well, maybe we should look at what it would be for the NASDAQ, because the NASDAQ was the one up 40%, not the S&P. I mean, if the NASDAQ were to drop 36% from those highs, sorry, clicked on the wrong thing. If the NASDAQ were to drop 36% from these highs, that puts it, at a new low. So yes, if something like that were to happen, I think the Fed would pivot a lot sooner than people think they would. And if that's the case, then that means the bond market would actually become a great hedge against the S&P 500. So it all depends on, it really all comes down to whether what we're looking at right now. Let me add on the average of pre-election years for the NASDAQ, right? It really comes down to whether what we're looking at right now is following something like 1987, or if it's just kind of more of the same, right? Maybe the NASDAQ sells off a bit more, but it still grinds higher. And I think that's the question that we all should be asking ourselves. Now, I think there are some warning signs right now, because the altcoin market is selling off pretty aggressively, honestly. I think a lot of people don't necessarily notice it because Bitcoin is up and it's kind of holding alts, up a little bit. But the altcoin market has been very, very lackluster recently. And if you were to look at, say, like the Advanced Decline Index, the ADI for the top 100 cryptos, most of them just keep going lower. So I think there are some warning signals that liquidity is really getting drained, and it could eventually filter over into the S&P 500. But that, I think, is the thing to consider. Is the correction by the S&P, is it seasonal? Because at this point, I think we can still say that technically it is. Okay, technically at this point, it is still a seasonal correction. But if it goes much lower than where it is right now, I think it kind of enters into the territory of it's no longer a seasonal correction, and then the market could starting to be pricing in a recession, right? So I think what we should do is look at how things behave, because I think the issue that we come across is that a lot of investors in this day and age, and I say this like I have experience. I have no experience with these business cycles because I haven't really lived through one. But just sort of looking at treasury yield spreads, we're sort of living in an age where, like, if it doesn't happen tomorrow, then it means it's not happening, right? So if someone says, there's a recession at the end of this business cycle, upon the uninversion of this yield curve, or maybe even before it uninverts, if it doesn't happen tomorrow, then people just say, well, it's not going to happen. But oftentimes it is a long process, and the period between inversion of, say, like the 2-year and the 10-year yield to when you get a recession can easily be upwards of a year or more. I mean, we first saw the 2-year invert the 10-year in the financial crisis back in February of 2006. We didn't have a recession until November of 2007, right? I mean, this was more than a year and a half later. You can see the 2-year inverted the 10-year over here in July of 2022. So we're already a little over a year, right? I mean, by the end of the year, it'll be a year and a half. So, and this, by the way, is becoming uninverted relatively quickly due to a bear steepener where the long end of the yield curve is going up, not a bull steepener where the short end's going down. At least not yet. So when you look at this, it sort of raises the question, well, like, how does the S&P 500 normally behave after yield curve inversion? And we can actually look at that, right? So if you look at ROI to low after yield curve inversion of the S&P 500 throughout these, these cycles that we've been looking at, this is what you get. So this is S&P 500 performance after the inversion of the 3-month and 10-year yield. Okay? This is the current cycle. This is 1973, right? This one here is 1981 to 1982. This is the dot-com crash. This is the financial crisis, right? I have to imagine that if people are living through the financial crisis, I mean, look how long you would have just sort of slowly scraped at the top, at the highs. So like imagine the labor market doesn't show weakness in Q4, and imagine the S&P rallies up in November and December, right? What if it just goes back to kind of where it was, and then just sort of slowly fades next year into a recession, right? There's a possibility that happens. It's actually even a more similar analog if you look at it overlaid with the 2-year and the 10-year inversion, right? So here's the 2-year and the 10-year, right? I mean, it's still following fairly closely. Now, in my own experience, these analogs don't follow that closely forever, right? They can look like they're pretty close, and then at some point they deviate. So I wouldn't expect it to play out in a very similar manner. I think, if anything, if the bear market is not over and we do put in a new low, I think it's more likely that we do something like the 1940s, where we go slightly lower than the prior lows, but it's not like a 50% drop or something. Again, looking at the period from 1946 to 1949, a period of high inflation, might be interesting to compare it to, which we did. The financial crisis was not really during a period of high inflation. It wasn't like the same type of thing, and so we maybe should compare apples to apples. But there's other things we can look at too, right? Not just ROI to low after yield curve inversion. Actually, I was sort of playing around with some of these other ones. There's interesting if you look at like the 5-year and the 2-year, and you look how it sort of compares. It actually is sort of following along at this point as well. But what I want to do is I want to look at inversion of the 3-month and the 10-year, but not look at the S&P. Look at some macro metrics, right? Look at something like imports of goods and services and see how is that trending this business cycle, right? Financial crisis, you can see it was actually trending up for a while. This cycle, it's actually been going down, right? I mean, imports of goods and services, I mean, you can see right here is 2022, it went down so far. If I isolate it in case it's hard to see, that's what it looks like so far, right? It's gone down. If we were to look at other things like, I don't know, what are some other ones that we could look at? Corporate profits after tax. Why don't we see what's going on there? This is 2022, right? Slightly up so far, but some of the other cycles also went slightly up and then eventually rolled over. I mean, even the dot-com crash, right, went slightly up for a while and then it came down. And in this case, this is underperforming what happened back then with the dot-com crash. Let's take a look at a few others. I'm just sort of doing this randomly. Like I don't have an agenda here. I'm just sort of clicking on random ones. Net percentage of banks tightening. We don't have as much history for this one. You can see we don't have as much history to look at, but that's what it looks like so far, right? I mean, it's gone slightly up. Let's look at another. Non-farm. Maybe we'll look at non-farm payroll. Total non-farm employees. So far, this one's outperforming a lot of the prior cycles. I'm going to remove the pandemic one. This is what non-farm payroll looks like so far. So it's been trending higher. But in all the other cycles, right? I mean, a lot of times it trends higher for a while and then it eventually rolls over once the Fed has gone too far. So I think the hard part is knowing exactly, at what point has the Fed gone too far. Looking at a few others, maybe just one more. Manufacturers' new orders. This is the current cycle, the pink line. This was the financial crisis, was the orange one, right? So we're underperforming that. We're overperforming what was going on in the dot-com crash. Maybe one more. Actually, there's one I just saw. Coincident Economic Activity Index. That might be an interesting one. So in this case, let me hide the pandemic one. That's what it looks like so far. So it's still actually tracking, the financial crisis. I mean, I don't think it's going to track it, forever. But I mean, it does show you that until something breaks, right, the economy can continue to expand. GDP can still go up as long as something hasn't broken, and as long as the labor market remains, relatively tight. Maybe there's also we could look at what like continued claims. That might be an interesting one to look at, and we'll hide the pandemic one. So this is continuing claims, right? And so if you look at the prior cycles, right, you can see what it's done so far. In this case, it's tracking the 1989 one, the closest, right? So here's 1989, and here's the current cycle, continuing claims. But again, I mean, if you go through a lot of these cycles, it can take a while. I mean, this is like, this is months after inversion. I mean, it can take a while for it to really start moving higher. Again, this sort of goes back to like, just because it doesn't happen overnight doesn't mean it's not going to happen, right? I think that's the thing. Like, it doesn't have to happen immediately for it to mean that it'll happen or not. So a lot of different things to consider, and I go back to this idea of like, everyone wants to know what their altcoins are going to do. But my thinking is that as long as we're going further and further into the tightening cycle, then they are still likely going to bleed back to Bitcoin, and that will likely lead the Bitcoin dominance higher, right? The dominance going higher, it basically just means we're getting into tighter and tighter monetary policy as people flee higher risk stuff for lower risk stuff, right? So it all comes down really to what the S&P is going to do, and does it sell off? And you might say, well, it's not going to sell off until the labor market shows weakness. Well, guys, it's sort of the other way around, right? Like if the S&P sells off, people get laid off, right? I mean, companies will lay off people if their stock prices are falling. That's why the stock market normally bottoms before the unemployment rate peaks. And we know that, right? I mean, don't take my word for it. Look at the unemployment rate. You see the stock market? You see how the stock market normally bottoms out before the unemployment rate peaks, right? Stock market bottomed here, unemployment rate peaked over here. Same thing over and over. Stock market bottoms before the unemployment rate peaks. So it's not the unemployment rate going up is going to cause the S&P to sell off. No, it's the other way around. It's as the S&P continues to show weakness, there's a good chance companies will continue to lay people off if their valuations are going down, right? Also, as the S&P goes down, the wealth effect takes hold. People don't feel as wealthy, and therefore they will curb their spending, which will lead to, companies not making as much money, which will then lead to layoffs, right? So again, it all comes down to how much higher can the long end of the curve go before risk assets say enough is enough. And if the long end of the yield curve starts to go down, it only is good for risk assets assuming there's no recession. If there's a recession, then the S&P goes down in tandem with the long end of the yield curve, likely. Bonds go up, and the S&P could put in a new low if there's a recession. I mean, that's normally what happens in a recession is the S&P puts in a new low. If there's not a recession, then it might not, right? It just depends on if there's a recession or not. And just because it has been a year or more after yield curve inversion does not mean that you should say that a recession is off the table, right? That would be a mistake. Okay, it still doesn't mean that a recession is going to happen, but I think the issue is that history shows us, history is our guide, history shows us that in the last several business cycles, the recession did not occur until the uninversion of the yield curve. There were prior times during high inflation where the recession occurred still during the inversion phase. So we might not even have an uninversion before a recession, right? So, but just because it's been a year or more since yield curve inversion doesn't necessarily mean we're safe from a recession. In fact, oftentimes it's when people think we've accomplished a soft landing that it's often at that point where a hard landing might actually happen once no one thinks it's going to happen. So, and by the way, one of the reasons that the S&P could be showing some of this, weakness, again, at this point, it's still potentially seasonal, as we showed, but if this continues, it could be due to the market worrying about a recession as the uninversion of the yield curve is taking place, right? You can see what happened over here with the S&P as the uninversion took place. I mean, it did go a little bit higher initially, but not much higher, and then it eventually sold off, right? You can look at it over here, right? I mean, the uninversion process over here, the S&P went up a little bit, but it still had a pretty massive sell-off after the uninversion. Same thing over here in the 1990s, right? Uninversion, and after it was uninverted, there's a pretty big sell-off. So still a long way to go, I think, before the business cycle is complete. I think that the markets are behaving kind of how we've mostly expected. I certainly don't get everything right. We know that. The receipts are there to prove that. But the S&P got the seasonal correction. The bond market sold off with it, as we thought it would, because the long end of the yield curve needed to go higher because the market was not pricing in higher for longer. Now that the market is pricing in higher for longer, or starting to, that could lead to the labor market showing weakness over the next 3 to 6 months. And if it does, then it could coincide with the uninversion of the yield curve, which often coincides with a recession. So that's what I want to talk about. Now, it was a lot, but I think we made it through. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out Into the Cryptoverse Premium at intothecryptoverse.com. We'll see you guys next time. Bye.